Yes, guys. Now coming to India's 19 employee benefit standard, very easy standard. There is just one kind of accounting. Apparently, is not very simple when you see first time. But if you understand it in the right sense, then that one small aspect accounting is still complicated, but that will be very easy for you. Barring that, rest of the standard, nothing is there. Very easy standard. Now, employee benefits include benefits given in cash or in kind to employee, spouse, or other dependents of the employee. So when I say employee benefit, it's not just something given only to the employee, even the dependents of the employee, spouse of the employee, even they are covered. If the company pays any benefits to the dependents or the spouse of the employee, even that comes under employee benefits. Next. Unlike AS 15, here all type of employees are covered. Full-time, part-time, permanent, temporary, contract labor, management personnel, every kind of employee is covered under the standard. The standard is obviously not applicable for share-based payments. Every kind of employee benefit is accounted under the standard except for share-based payments. Why share-based payments not applicable? Already we have another standard, Ind AS 102. Ind AS 102 covers not only normal share-based payments, even employee share-based payments or every other kind of share-based payments. Ind AS 102. Whatever benefits, employee benefits we discuss under this chapter are broadly covered into 4 categories. The 4 categories include short-term employee benefit, post-employment benefits, termination, and the other category is other long-term employee benefits. So there are whatever benefits an entity pays to an employee, they are all ultimately categorized into only 4 categories: EB, post-employment benefits, termination benefits, and other long-term employee benefits. Now, for each one of them, accounting is there. In hindsight, I am telling you, this is extremely simple, very cheap. But all something is there, that is discussion of this two. So that is the most important aspect that basically virtually takes our entire time of Ind AS 19. Remaining things very simple. Anyway, now how did they define all these things? Let us say this is current year 1/4/2025 to 31st March 2026. This is our current financial year. In the current year, employee has given us services. Of course, he will give us services in future also, but in the current year, he has given us services financial year 25-26. For the services what he delivered in the current year, whatever the entity pays to fellow are payable to this guy within 12 months from the balance sheet. Means up to 31st March 2020. Means for the services received by the entity in the current year, whatever is paid or payable up to a period of 12 months from the end of financial year, these are all covered as short-term employment. Sir, next year payments are also covered as next year payments which are being paid to him because of services given by him in the current year. Next year's salary will not become short-term employee benefit of current year. I am talking about whatever is payable to the employee up to the end of next year for the services what he gave to us in the current financial year. For example, an employee has served by entity in the current year. Bonus will be paid only when the results are finalized. Results will be finalized somewhere in July. So when will I pay him bonus? Somewhere in the August or September I will pay him bonus. For which year? Concluded year. So that bonus which is going to be paid 6-7 months after the balance sheet date, then that is also a short-term employee benefit for the concluded period. That's what I am trying to say. This short-term employee benefit. Next, in this what examples are covered? You all know salaries, so you are all pro from tax. So the normal salary, all kind of allowances, work visits. Then in this bonus, the short term every year bonus what we pay, that one. Leave salary, leave salary, the only thing that is slightly important in short-term employee benefits. Rest all are very easy. We'll see how to do accounting of. Then finally one day employee retires after some 25 years of the retirement date. After retirement or on retirement, whatever the entity owes to the employee, they are called as post-employment. You all know is your provident fund, pension fund, gratuity, post-employment medical care. These kind of covered under post-employment. So one is STB, the other one is post-employment. Next one is termination benefit. As the name itself indicates, termination benefit means what? Even before the retirement date, if the job of the employee is moved, either choose to voluntarily get out or company only laid off some employees, in the process we removed him. In that case, if the entity pays any compensation to that guy, that compensation is called as termination benefit. Termination benefit also we are paying at the time of he leaving the employment. Retirement benefit also we are paying at the time of he leaving the employment. Then what is the difference between termination and retirement is, retirement benefit is something pay when the employee completely fulfills his service period, whereas termination benefit is something which we pay when the employee suddenly leaves the job, either we removed him or he choose to get out because of voluntary retirement scheme. So here compensation example is your PRS compensation, and similarly there is something called as retrenchment compensation. These are examples about these two. So out of our four categories, we could see here short-term benefits, post-employment benefits, termination benefits. There is one more fourth one. That fourth one is not defined officially. So then who are long-term employee benefits? That's why they called it as other long-term employee benefits. Residual category, balancing here. Any benefit which cannot be grouped into these three be called as other long-term employee benefits. So basically other long-term employee benefits, even though officially they did not define it, you can easily observe. These are something which are payable to the employee during the course of employment only, but not at the time of he leaving the employment, during the employment. At the same time, not within 1 year from the end of the year in which services are, because if you are paying something to the employee within 1 year from the end of year in which services are rendered, it gets covered under short-term employee benefit. Not be short-term employee benefit, not be termination benefit, it not be post-employment benefit, then only it will become long. In this, usually what kind of examples gets covered is special bonus. Special bonus or also called as Jubilee benefit. Jubilee benefits means an employee has served us for a period of 15 years or let's say 10 years. 10 years an employee has served in our entity. So in order to remunerate or give him motivation or encouragement or as a kind of thankfulness, the company pays him some special bonus. You stayed in our company for a period of 10 years, I will give you 10 months salary as a bonus. I am not talking about the bonus which you pay year on year. That is normal, short-term employee benefit. At the time of joining only, I tell the employee that employee, if you stay in my company for a period of 10 years, 10th year ending, you will get 10 months salary as bonus. This is special. Similarly, some employees, when they finish 25 years, we may give a bigger benefit. These are all called as Jubilee benefits. Next. What other examples can we include in long-term employee benefit? Sabbatical leave. So there are some entities who give long leave to the employee. Means leave is not for 1 week or 10 days, not even 1 month, 1.5 years, 2 years, years leave company gives. Not private organizations, obviously, public sector undertakings, government related entities be common. What is expected is the employee will go out, update his knowledge in the current requirements and then again come back and join the job. In next 2 years, this fellow may be going for further study abroad or he'll be practicing somewhere, developing his knowledge, and that is the objective of sabbatical leave. But if you have to earn sabbatical leave, it is not like you join today, tomorrow morning you tell the employer, hi employer, okay, see you after 2 years. Meantime, you keep creating the salary, I will update myself and they give you. For that, you have to obviously serve a long period in the company already, then only that kind of benefit will be given to you. That is one thing. Next one is disability benefits. Disability benefit means, suppose sir, you are having lot of machining in your company, manufacturing organization. So somebody has to operate that machine, their hand or leg or body movement. Imagine a person who is doing the same kind of repetitive job for a period of, let us say, 15 years. What will happen? There is every chance that after 15 years, that part of the body may not function like how it is functioning for the rest of the people. Take the case of a person who is doing tailoring job. His body hand movements and leg movements are same, no? Throughout his 25-30 years golden period, he will be using in a particular way daily. What will happen? Obviously, body will be worn out compared to other people. So imagine somebody who has got a service period of 30 years, but he is doing the same job daily. After 10 years, it is possible that his hand may not cooperate him to do the same job anymore. And he does not know any other job. Since he is unable to do this job, the employer cannot continue him in the job. So what about his future? Company says, in case you are disabled in the course of your duties in our entity, one good compensation. A compensation will be generally like, put that money in the bank, you will get an amount which is almost equal to some 50 or 60% salary. Without working, you will be able to get that kind of compensation for your scheme. Normally what they do is they'll take an insurance policy so that if any employee gets injured or something, that an insurance company, is in practice it is there. But disability benefit, who will get? Suppose sir, you worked in X Limited company for 15 years, healthy. After 15th year, you left X Limited, joined A Limited. Worked for 1 month. Sir, my hand is paining. Give me disability compensation. A Limited will give a. You should obviously work long term in our entity. Then only this benefit will be given to you. And you all know leave travel concession that. So now coming to the accounting part. Let's first start with short-term employee benefit. Why I told you this is extremely simple and not very greatly important from an examination perspective is something which everybody knows right from your starting of accounting days. Tell me entry for salary, salary to bank, salary payable, salary to salary payable. Let it be any kind of employee benefit. Let it be salary, let it be allowances, let it be bonus, let it be anything. The entry will be same, sir. Entry will be employee benefit account debit, bank. In case you are paying it, if you are not paying it, then employee benefit expense and whatever account you created obviously will travel to, and the amount what you write here measured on undiscounted basis. What is the meaning of undiscounted basis? No present value accounting. Time value of money you should ignore when you are accounting short-term employee benefits. You should not come and argue with me that sir, employee rendered service here, we are paying him money on the last day of the next financial year. 1 year gap is there and I will discount. Don't do. 1 year is considered as too small a period to apply time value of money accounting. Standard is asking, do not do time value of money accounting. No present value accounting for short-term employee benefits. Let it be any kind of benefit, it will be only nothing great. If it is salary, rate salary. If it is allowance, call it as allowance. If it is bonus, call it as bonus. Names you keep on changing, entry structure change will not. Their clarity is there. In this, only one important aspect is there, that is about leave salary. The leave salary only also referred in the standard as short-term compensated absence. Short-term compensated absence means nothing but leave salary. Now imagine, sir, in a particular year, you are eligible for, let us say, 10 days leave. That means even if you do not come to the office for 10 days, I'm not talking about sick leave and all, normal casual leave, 10 days, even if you don't come also, company will still pay you salary. They will not deduct your salary. 10 days you are eligible to take leave. What you did, even though you are eligible for 10 days, you took holidays of only 4 days. That means even when everybody is holidaying, 6 days you still came to the office and worked. Did you work more compared to others? Everybody was enjoying, but I also enjoyed only for 4 days. 6 days I still came and worked in my office. Now, some employers, what they'll say is, you have worked more. Since you worked more, I will compensate your efforts by giving you some benefit. Some employers, what they will say is, you are inefficient. You are inefficient. Normal days lo given time lo you could not finish off your work. So remaining time lo you are coming and working. So first of all, continuing in job only is one big deal. Don't expect any extra consideration. So there are some employers who will recognize your extra work and they'll remunerate it to you. Some employers don't pay. If an employer is not paying anything for the extra days I worked, is there any benefit given there? When benefit is not given, what accounting will be there? No accounting. Case 2. Employer recognizes, okay, you worked extra. For this extra work what you have done, whatever extra leave days you spent in the office, for that we are going to compensate it to you. Now, how are you going to compensate it? There are 2 ways. 1. The extra leave days whatever you worked will be added to your next year limit. Current year 10 days are given, but you took holidays only for 4 days. You extra worked how many days? 6 days. The 6 days will be added to next year quota of 10 days. Next year quota is normally 10 plus 6 total 16 days. So in second year you are eligible to take total 16 days leave. Means the company, whatever extra work you have done, the company is asking you to carry forward it to the next year and take additional leave. Possibility 1. Possibility 2. Possibility 2 is company says you worked extra how many days? 6 days. For this extra 6 days, I am carrying it forward to next year. Next year you can take additional leave of 6 days, but if you are unable to take 6 days extra leave, in cash. There are 2 possibilities. If you extra worked, company may say carry forward to next year utilize it. You can't utilize it, you ask cash, I will give you cash. Possibility 2, no cash, must only take additional leave. Cash possibility is not. There are 2 ways of benefits passed on to the employee. That scenario where employee can claim cash also, can take additional leave also, that is referred in this standard as vested leave. It is referred as vested leave. The word vesting what you use in India's 1 or 2, there vesting means options are eligible to be exercised. That is the meaning there. Here meaning is different. Here vested leave ka meaning is, it is a leave which is earned by the employee, against which he can take additional leave also, he can claim cash also. That is called as vested leave. The other case where employee cannot claim cash but only take extra leave, that case is called as unvested leave. So 2 kind of leaves. So if it is vested leaves, what our standard says is, create a provision to the extent of full leave days accumulated by the employee. For example, there is a single employee. That fellow accumulated 6 days leave. His per day salary is 10,000 rupees. So 1 employee into 6 days into 10,000. Total, you should go and recognize an expense and a liability for the full leave days accumulated. When, sir? When it is vested. Sir, 6 days he is eligible, okay. But what is the guarantee that he will take all 6 days leave? Why do we need to create a provision for full 6 days? What is the answer for that? The answer is, if he is unable to take 6 days leave, he took only 2 days leave in the next year, what will he do? A remaining 4 days he will claim cash. So company point of view, we have an obligation to pay him money for entire 6 days, and there is every chance that he will claim that 6 days. If he is unable to take leave, he will ask cash. So standard says estimates and are not allowed. Full amount provision you have to create. So that is what you have to. Full amount provision. Coming to the other case where it is unvested leave, employee cannot claim cash. In that case, the standard gives a small relaxation. It says is, an employee is eligible for 6 days because he worked extra 6 days. But you go and estimate, even though 6 days are carried forward, out of these 6 days, how many days is he expected to utilize in the next year? only for that estimated days you should create a provision. One employee is there, he is actually eligible for 6 days, but that fellow is CEO of the company. When you look at his past track record, last 3 years, he never utilized it. Or out of the 6 days, let us assume that hardly 2 days he will utilize. He is eligible for how many days? Yes. But he is likely to use only 2 days. Since he is likely to use only 2 days, the standard says can create provision only for . So this is the accounting that is suggested. The first case, full provision. Second case, estimated number of days likely to be utilized. Only for those days provision has to be. Estimate is allowed in unvested leaves, not allowed in vested leaves. Why? In vested leaves, if that fellow is unable to utilize, he will ask cash. Second case, he cannot ask cash. Good reason. Yes, sir. Now coming to the accounting part. Accounting part, the entry is same. No, what is the entry we discussed? Employee benefit expense account debit to bank or liability. This is not bank. No, I am not paying him any money right now. So what is the entry you will write? Employee benefit expense account debit to liability only you have to write. So the entry there is leave salary account debit to provision for leave salary. Amount either you will create with full days or with estimated number of days utilized by the employee. In the next year, suppose you paid him cash, that fellow asked cash. What is the entry you will write in that case? Provision for leave salary, account debit to bank. Liability, you will simply close it off. What is there? Suppose he took additional leave. If he takes additional leave, your obligation is over now. Since your obligation is over, you should cancel the liability and credit it to salary account of, or directly you can credit it to his expenditure of current year, but it is getting discharged in how are you discharging? By paying him money? No, simply he did not come to office for another 6 days in the next year. So whatever liability or provision I created in the current year, that I will reverse it in the account. So I've given some example and all, you can go through. So this is all that is there about short-term employee benefit. One more point is there. Before I tell you that point, you should answer me. Okay, look at this. This is 31st March 2025, end of the current year. Okay. Now, our financial statements are getting approved by this date. In the mean period, management prepare financial statements. They have a first-hand idea of how much profit did they earn. The company earned a profit of 100 crores in the first year, this year. For this period, profit is finalized here. Then our management graciously announced of 10 crore employees. Employees ki management has announced. Because the company is very happy with the profit what they have earned, to share that happiness they declared bonus. Employees also were surprised. Our company gave us. Everybody is happy. So you are accountant of the company, tell me, when will you write the entry? You have two choices, 2024 or 2025, 24 25 or 25 26. When will you write the entry? Books of accounts are open, don't worry. Last year ka books of accounts are not yet closed. They are still open up to 31st July. But tell me, when will you write the entry? Concluded year, next year. Concluded year. Sure. Next year. There are two options. Don't search for third one. Don't know one option. None of the above is not applicable. The answer to this. Here. If you have to take cognizance of this and write an entry on this date, it should become an adjusting event. It has to be an adjusting event. First of all, there should be a condition on the balance sheet. Did we promise to pay bonus to the employee already? If promise was already there, it means what? Obligation to pay bonus was already standing on 31st March. In the next 3 months, we got clarity about the amount of bonus. In that case, it will become a adjusting. If there was no obligation to pay bonus here, suddenly you declared bonus here. Of course, looking at the profit of concluded year only, but there was no obligation on the balance sheet yet. When obligation are not there, how can you create a liability provision on the balance sheet? Ultimately, the answer depends on what? Obligation to pay bonus. It can be legal obligation, it can be constructive obligation, does not matter. But obligation must be there on the balance sheet. If it is there, then you can recognize this bonus expense and liability on the balance sheet date, even though amount is finalized after the balance sheet. Sir, no such promise is existing. Fantastic. Don't recognize now, recognize directly in the next financial year. T526. Clear till here? On this also questions are easy only. What question is? Okay. This is about this profit sharing plan and bonus which is after the balance sheet about. So out of our 4 categories, short-term employee benefit, 1 category accounting is sorted. Now coming to second and third, termination benefit we'll talk towards the end because it's the most easiest one. So coming to post-employment employee benefits and other long-term employee benefits. There is a small good news, but even before we enjoy that good news, there will be a small bad news also. What is that is, even though these two are 2 separate categories, the accounting for these two, so even though 2 categories are there, accounting is same. So you have to learn only one model of accounting. That is the good news. Bad news, the accounting again depends on whether the benefit what you are paying to the employee will be categorized as a defined contribution plan or whether it will be classified as a defined benefit plan. If it is defined contribution plan, you have one type of accounting. If it is defined benefit plan, you have other type of accounting. So ultimately you have to learn again 2 types of accounting. DCP one accounting, DBP another accounting. Now, just to make you connect to this discussion, just telling you some random examples, try to understand. I told the employee that employee, you stay in the office for a period of 5 years. If you stay, at the end of 5th year, I will pay you 5 months salary as bonus, jubilee benefit. Then when will I have to pay to the employee? After 5 years. How much amount? 5 months salary as bonus. Is it during the service only? No? Payable during the service. That means 5 months salary payable as bonus at the end of year 5. Remember, this is one example. Tell me this gets categorized into post-employment benefit or long-term employee benefit. Long-term. Fall under other long-term. Next one. Provident fund payable. PF contribution. PF contribution employer will make every month, but it is payable to that fellow when? The retirement date. This is very clearly a post-employment. Correct? You told the employee that, employee, now that you already completed 5 years of service, eligible for gratuity. At the time of retirement, for each year of service rendered, your last drawn salary 15 by 26 to number of years of service rendered, that much amount I will as a gratuity. Then the time of retirement. That means, do you also agree that gratuity, example, whatever we are talking now, this is also a post-employment. There are some benefits which are long-term, some benefits which are post-employment. Let it be any kind of benefit. Our accounting is not based on whether it is LTBA, whether it is post-employment benefit. It's not based on that. Our accounting is based on whether this is classified as defined contribution plan or whether it is classified as defined benefit. Now, what is the meaning of contribution? Contribution plan means, as the name itself suggests, here The obligation of the employer is just to make a contribution on behalf of the employee to some third party fund. Once I make the contribution to that fund, employer will not have any further risk. Simple classic example of defined contribution plan is, I tell the employee that, employee, every month on your salary, basic salary, into 12%, I will contribute to a PF authority. At the time of retirement, whatever money I am contributing, that money you can take. Sir, whatever you have invested in PF authority, same amount they will give us, some extra also they will give. Extra also they will give. Extra, why are they giving? The money what I am giving to PF authority is investing somewhere. Our investment returns will come. Our returns after meeting their admin cost and all, our returns are passed again to the employees. Correct, no sir? Suppose after 25 years you retire. After 25 years you retired, you saw how much PF authority has given you money, a big lump sum money you got. You are still unhappy. You are saying that, what is this sir? PF authority does not know how to manage fund. I overall got only 9.5% compounded return. Had you given this money to me, I would have earned 14% per annum compounded. So I lost money in PF authorities. Let us go and attack the employer. Ask the employer remaining 6%. The employee come and give you. The employer say, my obligation got over the moment I have. What did I promise there? Did I promise you money on retirement data? No. What did I promise? I promised to contribute. That's all. The moment I contribute, my job is over. That money, at what rate PF authority is investing, where they are investing, that is never promised. How much return you will get on maturity date, I never promised that. So whether you are happy or you are sad, I don't have that. Clear with this? This is defined contribution. Case 2, defined benefit plan. Defined benefit plan, the employer goes ahead and makes the promise of giving a particular benefit. Here the promise is not contribution. Promise is, I will pay you some X amount and I committed. Now risk is there on the head of the employer. This is called as defined benefit plan. It's a simple example. Okay. Suppose there are 1,000 employees in my office. The employees are frequently leaving and all, like a software company employee. So in order to make them stay, what I told them is, guys, stay in my company for a period of 4 years. At the end of 4 years, I will pay 4 months salary as special bonus to each one of you who stays in the entity at the end of 4th year. All employees are happily accepted. But this fellow's mind lo, sir, the employer mind lo, what is there is, even though 1,000 employees ki I made a commitment like this, in my opinion, only 700 employees only at the end of 4th. That's my feeling. Since anyway 700 employees are only going to stay, what I did is, every year I booked an expenditure, created a liability. First year, second year, third year, I booked expense, I created liability. I booked expense, created liability. And by the end of 4th year, in my balance sheet, see, I have a liability created for 700 employees. Fourth day ending, I went and counted how many employees are there. There are 760 employees. Is it beyond the expectation of the employer? Can I go and tell these employees that, employees, you 60 people are beyond my anticipation, I will not pay you? They accept that? Because promise was made to all 1,000 employees. You compulsorily have to pay to all 760 employees. Isn't it? Suddenly think from an accounting perspective. 760 employees ki bonus if I have to pay is coming to 350. But in my balance sheet, liability is recorded only for 300 crores. Suddenly what will happen now? Company has to book an expenditure of, this is coming because of an estimation error. This is called as actuarial. Actuarial risk means there is an increase in the liability or decrease in the liability because of change in estimate. Called as actuarial risk. It can be gain also, it can be loss also. So this risk contribution plan it will not be there. Why? In contribution plan, I never promise the benefit to the employee. I will only promise a contribution. I will pay to some third party some X amount. The moment I paid that, the risk is over. Whereas here, I did not promise a contribution. I promised a benefit. So in case estimation error is there, a risk who has to take? Employer has to. In this, another risk is also there. That also is. Same example only. 1000 employees are there. Employer make an estimate that only 700 employees will, and 700 employees ki estimated that overall I have to pay an amount of 300 at the end of 4th year. This is our employer ka estimate. Suddenly, where will money come from, sir, at the end of 4th year? I know that I have to pay 300 crores, but money, where will it come suddenly? It won't come, no. So what is this fellow doing? Every year he is making some investment. Like sinking fund investment, every year he is making investment. What is this fellow's idea? Towards the end of 4th year, I investment I will sell it off, convert that into cash. Our cash I will go and repay my obligation. That's the idea. But what happened is 1, 2, 3, 4, 4th year ending, when you sold the investment, you planned to receive 300 crores, but unfortunately, you got only 270. With a sad face, you went to the employees and telling them that, the employees, for you only I created investment. Today I owe you bonus. For that purpose, I sold the investment, but our investment is falling short of how much I have to pay you. So kindly adjust the 270 crores only. Somehow you people manage. 30 crores, kindly forgive me. Will they accept that? Means what? There is a risk that whatever assets, whatever investments you made, those investments are not sufficient to meet your defined benefit obligation. In that case, a loss who has to bear? Employer has. This is called as investment. It is also part of actuarial risk only, because fluctuation in the investment is creating a shortage for you. That is also a kind of estimation risk only. So even though this is investment risk, this also comes under the category of actuarial. Two kind of risks are there. One is actuarial risk, the other one is investment. Actuarial risk because of estimation error. Investment risk means there is a possibility that the assets what you have invested elsewhere, assets may not be sufficient to meet your obligation as investment risk. The two risks who has to bear? The employer has. Right. Now, out of these two plans, this discussion we will do towards the end because it's very simple. 2 minutes it will get over. The entire standard ka hallmark is only this. The entire standard, if at all somebody does not like Ind AS 19, that should be because of defined benefit. So this is the most biggest accounting. We'll first target this, finish off this, then we'll come to defined contribution. And once that is also over, we'll go to termination benefits. That our standard is. Here now, how to do accounting for defined benefit plan? The standard gives you a method is called as projected unit credit, or shortly PUCM. Projected unit credit method is what you have to apply for accounting of defined benefit. All defined benefit plans ki ide accounting. Now how to apply this? For this, certain steps and all are there. What you do is in the concept book there is an example, page number 10.5. Open that example, sir. You have to solve, keep your calculus also. Yes, guys. Mr. A is employed at a monthly salary of 80,000 rupees at X Limited. His salary is expected to increase at the rate of 10% per annum starting from second year. A is eligible for a bonus of 1 month salary for each year of service rendered at the end of 5th year. Each year of service means by the end of 5 years, 5 years of service. 5 years into 1 month, 5 months salary bonus. Such bonus is to be computed on the basis of last drawn salary. Show the accounting in the books of X Limited assuming a discounting rate of 12%. So, go on filling up, sir. Step number 1 is you have to estimate the projected cost. Projected cost means After 5 years, how much benefit should we pay to the employee? Estimate it today. How much benefit you have to pay? 5 months salary you have to pay. And that salary should be not today's salary. Salary at the end of 5th year though you have to pay. Last drawn salary. First our job is to work out last drawn salary. So, copy this. Salary equal to 80,000 per month in year 1. I don't want year 1 now. Salary at year 5 ending 80,000 into 1 plus. The question gave you salary escalation rate. Every year salary will increase by 10% per annum. So up to how many years? 5 years. But first year low there won't be any escalation. No, he joined now only. Immediately I'll give raise. No? The raise will be given from second year. So second year, third year, fourth year, fifth year. 4 years you have to consider. For this. This is last drawn. Then compute bonus pay. Five years completed. Each year ke 1 month into last round. So 5,85,640 rupees is the total projected benefit payable to the or total cost to the company at the end of is payable. That our first. Indirectly, 585, the amount of liability in your balance sheet by the end you reach 5th year ending. This is the estimated amount that we have got to pay to our employee. Step number 2, allocated cost per annum. Allocated cost of what you will do. First step of whatever answer you got, that you will amortize over the period of you giving benefit to the employee. That means is supposed to serve you for a period of 5 years to earn this benefit. The number of years of service employee has to give to the entity to earn this benefit. 117, 120. Can't I directly copy this here? Pure coincidence it came. If I give 1.5 months salary as bonus, it will not come. If I put some percentage on the salary as bonus, it won't come. It's just coincidence. Don't take it to step number 2. Means it is per annum cost. Step number 3 is called as current service cost. This is the most important step in our calculation. Current service cost means, correctly observe, sir. If you look at the table, it will be misleading. Be careful. How is the table looking? Here 1, 2, 3, 4, 5. What is allocated cost per annum? We got 117. 1. And next column, no, they gave you discounting rate. You will write discounting rate. So obviously, when you write in one column, another column low PV factor rate, third column we feel like discounting everything and working out. Not that. This current service cost, this is not that. Careful. Discounting A, but it is not your cash flows and all. Sir, whatever I wrote in second column are cash flows. They are not cash flow. The first 117, 128 is cash flow first year. To discount it to today, is this year. Correctly observed. Very simple thought. At the end of year 5, I have to pay 585,640. If 585,640 has got 5,117,128. How many 117,128s are there? 5,117,128s are there in that 585,640. 1 year is over. By the end of first year, employee has given us some service already. For the service what he gave, I owe him an amount of 117,128 at the end of year. And I am standing already at the end of first year. From the end of first year, fifth year ending is 4 years far. So, 117,128 which I have to pay after 4 years, which is actually 5th year ending, has to be discounted to today, 1st year ending, and recognized as a liability in your. So, sir, you gave me some service. I owe you 117,128, not now. After 4 years, I owe you. So today, you should recognize the liability at present value, just like ACM. So, the discounting rate, what you write here, the 4 years discounting rate you have. So, come to second year. When I talk about second year, you gave me service the second year. Now I'm standing at the end of second year. I owe you 117,128 at the end of 5th year. So I owe you money after 3 years from where I'm standing today. So I have to discount it by 3 years. When I'm standing at the end of third year, I owe you money after 2 years. Count it by. When I'm standing at the end of fourth year, I owe you money after 1 year. When I'm standing at the end of 5th year, I owe you money right away, immediately. Factor will. Multiply this one, tell me the figures. The question is quite popular, sir. Of course, recent past law, last 4 exams, 5 exams, it did not come. But under India's exams only, it came twice. Normal AS CA final exams, so this was a very popular question. All these 4 steps. Careful with it. Easy only. If this comes, it's like, free or 6 marks, 8 marks, or whatever comes, it's absolutely free. So, sir, step number 3, you identified the annual cost. Come to step number 4. Step number 4 is like building a liability sheet. It's nothing but a kind of ledger account preparation only in the model of a table. Now, by the beginning of first year, did he give me service? Beginning of first year, he did not give me any service. I don't owe him anything. But by the end of first year, he gave me some service. For that, I owe him 74,435 at the end of first year. Since end of first year I recorded, interest liability will not be recorded on this. So my closing balance 74,000. When I come to second year beginning key, I already owe him this. Throughout the second year, he worked for me. For that, I again owe him 83,000 is 70. But 74,435 on that interest also have to recognize. 74,435 into 12% is 893 total item. Current service cost we are adding on that again interest 20,000. 80 total item. Now, when you are in the last year, whenever you do time value of money accounting, values and all, approximation error will be there. At the end of 5th year, I already know that I want a liability of 585.6. Rounding of error invariably will be there. Interest portion you take it as how much? this is your liability sheet. The moment you see this liability sheet, you will indirectly understand what is your impact on P&L account each year. This is your P&L account impact. Even interest also is your P&L. These two you have to put it in P&L account, and since you are not paying every year immediately, you have to create a, so your entry will be current service cost, interest cost to liability. Instead of calling it as bonus payable, gratuity payable, pension payable, other different cases you call. The question is silent and all, you can simply call it as present value of defined benefit obligation, CVDBO account. So entry will be CSC, current service cost, interest cost, liability, and the CSC and IC both will jump off into PRL, into OC. PRL ka happily it will go. Like this, if you do accounting for 5 years, what will happen? By the end of 5th year, your PVDBO account, you will have a balance of 585, 640. Go and pay liability account. Are you understand that this is a basic accounting of defined benefit plan? If you understood this, on this you have to build further. The very base, but this base itself is an important question for exam. On this further issues are there, they are even more important, but up to here you cannot have. In this one point, I have to tell you more clearly, but that we will discuss towards the end of the standard, because that is irrelevant now. That is for handling some separate questions. Denominator law, which years you have to take, and question is that not a very great important question. Whatever it. Come to next example. Sir. The example you need not solve. Just go through the numbers. It's a very interesting example. Consider the data given in the above example. Same sum. Show accounting entries at the end of year 3, 4 and 5. Third year, 4th year, 5th year entry is asking, assuming that escalation rate is 15% in 4th year and 5th year. Saying, what did we assume in this entire calculation? Salary will escalate only at the rate of 10% per annum. When salary escalates at the rate of 10% per annum, then only his last drawn salary is 117, 128. Then only bonus payable will be 585, 640. But during this 5 years, if any time I understand that salary is going to increase at a different rate, that means his last drawn salary is going to change. When last drawn salary is going to change, the amount of bonus payable is also going to change, which means whatever liability I am accounting as per this liability sheet, it will only become 585, 640, but I don't want 585, 640 now. I want either a higher number now or a lower number. Do you agree that this is a change in estimate? Right. Now, in a hindsight, you already know, because of change in estimates, your liability either increases or decreases. That is either a actuarial gain or a actuarial loss. How to compute that actuarial gain or loss? The example we will see. You have so many questions in your study mat and all, nowhere they told you how to compute actual gain or loss. This is one question which will give you a first hand idea of how actual gain or loss is computed. Very simpleton case, but you will get an idea. Now tell me, sir, he is asking accounting for which year? 3rd year, 4th year, 5th year. Why is he not asking 1st year and 2nd year? Already completed. You are in 3rd year, accounting yet to be done, but you realize that 4th year, 5th year, the salary escalation rate won't be 10%, it would be 15%. Because of that, estimates will change are there. The moment estimates will change are there, ma'am, the entire calculations, whatever we done originally, totally wasted. Then you have to redo the whole thing. What? Step 1, last drawn salary, projected benefit. Step 2, allocated cost. Step 3, current service cost. Step 4, liability sheet. Again, you have to recreate with the latest estimate. So, if you look at the solution, then I first worked out the last drawn salary. It came to 1,28,000 something. Then benefit payable is 6,40,000. Allocated cost per annum is 1,28,000. Then again I built current service cost table. Then I built liability. Till here we came. Here you stop correctly. You are already in which year now? Good. You are already in 3rd year. In 3rd year, if I prepare my liability account, can you tell me what is my opening balance? Your opening balance is based on this revised liability sheet, old liability sheet. Old liability sheet. Because first year and second year you accounted not as per this revised sheet, as per old liability sheet. And according to that, your number was 166,739. Correct? Now that things are revised, current year related current service cost is this. Current year related interest cost is 21,869. Looking at that, what is the entry you will write? SC account debit, interest cost account debit to PBDBO. So tell me the numbers now. By current service cost. So 2, 5, 6, 5. Interest cost 21,860. These two you will write. According to the latest liability sheet, the closing balance should be how much? 306,160. Closing balance also revised I will write. Do you think that this ledger account will tally now? Will not tally. Why will it not tally? The opening balance is not as per revised sheet, it is as per my old liability sheet. Pakka account will not tally, it will throw up a difference. According to my old liability sheet, opening balance is 160, but according to my revised sheet, it should be 182,241. A difference come out in this account as a balance. This is how you experience actual gain or loss while doing your examination questions. Balancing very awesome, sir. Anyway, amount is coming to 15,000. Tell me this. If 15,502 is increase in liability or decrease in liability? Very clearly, this is increase in liability. If liability is increasing, is gain or loss of us? Therefore, this is an actuarial loss. The entry what you will be writing is actuarial loss accounted to by. The actuarial loss is also called as a remeasurement loss. That's another name. Both any. Sir, till here clarity is there? Tell me, ma, CSC will go to PR. Interest cost also will go to PR. Actuarial loss, where will it go? Actuarial loss ka treatment is very interesting. Actuarial loss ka treatment depends on what you are accounting is a long-term plan or post-employment plan. Till now we never differentiated. We only spoke about the defined benefit plan or defined contribution plan. If it is defined benefit plan, you have to apply projected unit credit method irrespective of whether it is long-term plan or post-employment benefit plan. But if you get an actuarial gain or actuarial loss, the treatment of that actuarial gain or loss depends on whether you are accounting for LTEB or P. If you are accounting for LTEB, long-term employee benefit plan, our standard feels that long-term employee benefits plan ka gain or loss will be ultimately realized in an observable period. 5 years bonus I planned, sir. Every year I am getting some actual gain or loss, but ultimately whether gain or loss, when will I know? By the end of 5th year I will know. No, that is observable period. Therefore, if it is related to LTEB, it will go to. If it is related to post-employment benefit, then you cannot take it to PRR, because where ultimately you will have gain or loss. When will I know? After 30 years when this boy retires. Correct? So that is too much bigger period. Unrealized gains for so much period, I cannot keep on hitting my PRL and make my EPS dance for some unverifiable gain or loss. That portion will go into OCA, and this is non-reclassifiable. What is the meaning of non-reclassifiable? After 30 years, when ultimately I will know whether it is gain or loss, that becomes a realized gain or loss. That realized gain or loss cannot be recycled into PRL, it will be merged into retained earnings directly. So if somebody asks you actuarial gain or loss, where will I take? That depends on whether it is a long-term employee benefit plan or post-employment benefit. Clear, sir, till here? This story I have written. Actuarial loss is also called as remeasurement loss. The treatment of remeasurement gain or loss depends on whether it is LTEB or PEB. If the remeasurement gain or loss relates to LTEB, it is recognized in PRL. If it is relating to PEB, then it is recognized in OCA section, not to be. In the present example, it is bonus. Bonus will be a long-term plan. Therefore, this will go to PRL. In the example current. Some other question when you solve, it can be going to OCA also, depending on whether is LTEB or P. So till your clarity is there. This one portion of defined benefit plan basic is over. So coming to the second part. This is called as the story of plan assets. When an employer commits a particular benefit to the employee, that which he is going to pay long term in future, sometimes at the retirement, sometimes after some 4 years or 5 years, the employer fellow will be scared first of all. Suddenly money, how will it come later on? We should make investments for that. Those investments can be made in government bonds, any other normal bonds and debentures issued by the companies. It can be made in insurance company investments. It can be made in mutual funds, shares, a fixed deposits, or a dedicated bank account. Any kind of investment employer can make in accordance with the terms of the plan between employer and employee. All these assets collectively are referred as plan assets. Look at the name. Plan assets means assets which are maintained to meet the obligation under defined benefit plan. That's why this is called as plan assets. Normally when you buy an investment, what is the entry we are writing? Investment to bank. In this particular chapter questions, they will not tell you that you purchased investment in share, you purchased investment in bond, you purchased mutual fund, you invested in FD, like that they won't tell you. They will simply say that we contributed to plan assets. We contributed to plan assets ka meaning is indirectly this fellow went and purchased investment. The entry what you should be having in your mind is plan assets account debit to bank. Let us say I write with an amount of 1 lakh. Plan assets account debit to bank. Second, whenever an employee retires, I have to pay him money. If I have to pay him money, our money I have to withdraw from my plan assets. For withdrawal, the entry will be bank account debit to plan assets. After writing this entry only, you should go and write PBDBO liability account debit to bank account. Already we discussed that when bonus is paid, we will write PBDBO to bank. There's no here. PBDBO to bank, last entry. Our entry, if you have to write, bank outflow should be there. So first of all, bank low money should be there. A money you will withdraw from your plan assets and then only you will do this. Right? Now, next thing. On these investments, I will get some returns. Returns like interest income, dividend income, capital appreciation in the investments, all these returns I will get now. So ideally, when you get any income, our income also is again reinvested into the same plan. Okay, so like a compounded effect. So entry should be normally, see, when you receive interest income from anybody, the entry which I will write is bank account debit to interest income. Example. But money is also again reinvested. Therefore, instead of calling it as bank, we call it as plan assets only. Because bank is also part of plan assets. Some money, whatever returns I am getting, returns also I am reinvesting. So plan assets account debit. Instead of crediting or recognizing the actual return on plan assets, dividend income what actually you received, interest income what actually you received or receivable, capital appreciation in the investment, instead of recognizing that, our standard asks don't recognize the real return on plan assets, don't recognize. Instead you should recognize something called as a expected return. Sir, expected return means it is not the return what you actually earned, it is the return what you thought you will earn. So a dummy return to accounting you should. This is not real return. Real return is something else. It is dummy return, what you planned to get. The dummy return though you should write the entry, you should debit the plan assets. Not only that, you will also transfer this to your dummy returns are how can I credit my P&L account? This is not my actual return. For that correction will be there. Now to make you understand this concept, I'll give you an easy example. Follow this. Suppose sir, there is a defined benefit plan. Under this defined benefit plan, our company has to pay to our employees an amount of 10 lakh rupees after 3 years. The employer wants to make investments at the end of first year, second year, third year. How much money should he invest, to tell me? Every year, how much he should invest? Is it correct if you say I will invest 3,33,333? That's correct? Not. Why? Because on the 3,33,333 you will again earn interest also. So ultimate amount will be more than 10 lakhs. I don't want more than 10 lakhs. So you need not invest 3,33,333. It is sufficient if you invest something less than that. Sir, how much, sir? That depends on how much expected return you are going to earn. Based on that, your quantum of investment in each year is decided. Correct? No? So without going into too much numbers, I'm just making the process easy for you. 3 lakhs, 3 lakhs, 3. That means what? Our employer will contribute an amount of total 9 lakhs. When he contributes 9 lakhs, what is his feeling? In 9 lakhs plus the returns earned on this 9 lakhs put together will be equal to 10 lakh rupees, which will be used to repay my obligation. That's the plan. So can I confidently write that employer has expected a return of 1 lakh rupees? My total investment is how much? 9. I believe that I am getting a return of 1. So overall it will become 10. Questions what you solve, in that amount it will not be given. They will give you this in percentage terms. Questions we will see later on. Models we will see, but just for understanding. Now I am writing gross entries. You see whether you can understand. When I make investments, the entry I will write is plan asset account debit. 3 plus 3 plus 3 total. How will you write like that? Array, sir, simply I am writing so that you will understand the overall effect. Every year only I will write normally, just for understanding I am doing plan assets account debit. What is your expected return? 1 lakh. That expected return, go and write the entry. Plan assets account debit to. So you not only recorded this dummy return or a wanted return, and this you transferred it to your. Sir, because that 1 lakh is a wrong number, your P&L what went also is wrong. Because you adjusted that to plan assets account also got spoiled now. What you will do now is identify the fair value of plan assets. If you dispose of this plan assets now, how much money are you going to get? Let us say I am expected to get 10 lakh 40. Now carefully think, how much did you invest? What is the worth of the investments now? 10 lakh 40. So if you sell off, how much return are you getting? 1 lakh 40,000. How much did you expect? How much did I expect? 1 lakh. How much am I getting beyond my expectation? That 40,000 also should be accounted now with the name of actuarial gain. Like how liability law actuarial gain or loss is there, plan assets law also actuarial gain or loss has to be recorded. So, the plan assets you observe, this is originally recorded at 9 lakhs, again recorded at 1 lakh, plan assets ka carrying amount is 10 lakhs, updated to 10 lakh 40,000, means the entry what I should pass now is plan assets account debit 1000 credit to actuarial. Like how expected return went to P&L account, actuarial gain also will go to P&L account. What will happen? 1 lakh also went to P&L, 40,000 also went to P&L. Total how much went to P&L? 1 lakh 40,000. What is 1 lakh 40,000? The actual return. Ultimately, accounting will happen only for actual return only. Out in that. Am I clear till here? Now, sir, this actuarial gain of 40,000 what you recorded, where will it go? Again, same answer. Either go to PRL or it will go to OCA, depending on whether it is LTEV. Place of remeasurement gain, actuarial gain will not change. That is same concept what we discussed under ability side. That side also same discussion. Now, can I also make a comment now like this? Actual return on plan asset equals to expected return plus actuarial or minus actual. This statement correct, sir? This is It's totally important, sir. So examination question though, how you will face this means how the question presentation will. Visualize a plan assets account like this. Okay. Question already will give you opening balance. Come on. Question will tell you that you have made some contributions to plan asset. In the current year, you paid some benefits under it. By paid benefit, you would have withdrawn money from this. A point expressly they will not tell you, you should catch that on your own. By bank. Then the question will give you expected return percentage. What you will do is, take the entry to percentage in. No information is given now, sir. What you will do is, a percentage you have to apply it on the opening balance. If I am applying on the opening balance indirectly, my meaning is, the further money invested, the money withdrawn, is to happen at the end of the year. Throughout the year, only opening balance was invested. So I am applying percentage only on the opening balance. Nothing is given, do that. If you do anything else, assumptions you can write, but this answer will match with ICAI answers. In that case. In this, one more twist. Some questions, they won't even give you this percentage number. Expected return percentage, they will not give you. This is missing by chance. If not given, use discounting rate of PVDBO as expected return. If it is given, definitely take it. If it is not given, discounting rate of PVDBO, you have to use it here as expected return. A point also I wrote here. If the question does not provide expected return percentage, consider the discounting rate that is used for measuring PVDBO only as your expected return. Question you should not be searching, sir. Only 1% is there. A percentage you use for PVDBO, the same percentage you will use it for expected return. Ideally, are they correct? But there are questions where separately also. Now look at this. You originally, this you wrote, also you wrote. This correct. This number is not correct. The expected number. This is not the real return what you want, but the dummy number. So, a closing balance, whatever we write here, it should not be balancing figure and all. This should be recorded at farewell. The question will give you. Don't worry. The number also will be correct number. Now, the account Pakka will not. Pakka difference will come. You already know. It will be a actuarial loss, or here you will get a actuarial balance. This side. So, typical examination question. PVDB account we have seen. We'll do one or two examples on overall picture. Do you have clarity in this? Sir, actuarial gain, actuarial loss, really how they are coming, that we'll have an idea. And we also should have an idea that while doing a sum, where will they come? Question lo, sir, this data they will give you, this data they will give you, this they will give you. The percentage they may give you. In case they do not give, you will use discounting rate of PVDBO only as your expected return. Key number also question will. Obviously, they will not give you actuarial gain or actuarial loss. A number will come as a balancing figure. That fellow's question will be compute actual return on plan assets. Tell me, sir, how to do? Compute actual return on plan assets. The expected return number, whatever is there, that one, plus this actuarial gain or minus this actuarial loss. A number will be your actual return on plan assets. This is one very, very popular. Or plain maths or nothing else is a very, very easy case. So, sir, now I'll take you through one question. What you can write, or else you can just watch and understand how this is. These are learning concept is one thing, Adi exam range ki conceptually you should be able to watch this question number 16, sir. This is an old IFRS question. This got copied into our CA final examination also, study material also. This only they are repeating, they don't have any other question. Okay, various variants are there. This is a original source question. Good question. The following info is provided in relation to a defined benefit plan operated by Celine at 1st Jan 20x4, beginning of a particular year. PVDBA is 140 million and plan assets ka fair value opening balance is 80 million. Liability opening balance given, asset opening balance is given 2000x4. Well, is following Jan to December model. Two columns are given, you bother yourself only with 2000x4. Discounting rate is given as 4%. Current service cost and past service cost they have given. What is past service cost? Later on we'll discuss. Benefits paid, contribution into the plan, PVDBO closing balance, plan assets ka closing balance. But requirement is determine the amount that will be taken to PRL and OCA for both the financial years together with the net plan obligation or asset. Net asset you will have, a net liability you will have. The end of the year. This is the maximum question institute can ask on defined benefit. Full version. There is one more adjustment also they can add, but that's a stupid cheap adjustment. Don't worry. This is a very proper question for. Okay. We will take only 2000x4 data. We will try to solve. What you do is draw two ledger accounts. Question you need not write. Question I will package. Question is not good. Draw two ledger accounts, each account 5-6 lines. One is PVDB account. This is a liability. The question is our exercise, sir. In this, end result will be very nice. PVDB account and plan assets account. He told us that opening liability is 140, opening asset is 8. Discounting rate is given as 4%. So, by interest cost, 140. For the love of God. By current service cost, ESC recorded, IC recorded. Plan assets ki contribution is given. Plan assets contribution is what? Plan assets account debit bank. $25. The question also told benefits paid 20. What's the meaning of benefit paid? Liability paid. So, liability paid, liability account debit to bank. Good. This not forget. If you forget, is over some there. If you are paying liability, means you are withdrawing money from plan assets and then you are paying the liability. Okay, sir. Clear clarity is there. So, what else I have to write? Expected return I have to write. The 20 should be written in both the accounts. Here it is called as benefits paid. Here we should describe it as withdrawal. Draw money and paid money. Like here I have to write dummy return ka entry. Question is silent about expected return. Most of the questions are silent only. The question is silent. What you will do is whatever rate you used for PVDB or discounting rate, that only should be expected and also ideally use that for 80 into assuming that changes in plan assets happened at the end of the year. Opening balance to the return you will. Also, we posted everything. For closing balances, post, then you will get your missing figure as actual. That's it. Closing balances are 201 to liability. That's it. So try and balance it. Here 170, 175.6 to 40 here. Liability look, credit side means liability is increasing. Okay, loss. This side 80, 105, 108.2, side 140, 81.8. Asset side, debit side number is coming, asset is increasing. Real measurement. This question, what is happening? Whatever we discuss, just I am posting that, nothing else, nothing else. When you prepare your P&L account, in that first section, PRL will be there. In this PRL section, sir, right, we'll have a heading already, no? Under that employee benefits heading, means in computation of that employee benefits heading, what numbers? CSC. What is CSC number we got? Interest cost is what? The return what you are earning on plan assets, no, that you cannot call it as other income in P&L account and all, that is wrong. If you write it in other income, the shareholder also will want that. That shareholder, that is for employees. Expected return, point to what? No. Overall impact will be what for? Sir, what about actual gain or loss? Nothing is given. The question is asking, what will you show in OCA? I will show that in OCA. Sir, the long-term employee benefit plan, pension plan, we do not know, no, sir. We do not know, no, do it in OCA. Why to force everything? When write something in OCA also. Net remeasurement 44.40 lost, and in this account we have a gain of expense. This is fact of PRL section. That fellow cutely will ask you this, but to do this, all that labor work you have to do, preparing all that ledger. There is one more smart way of getting it, that also we can. So here it's clear. Coming on to the balance sheet side. You have a liability and you have an asset, correct? Both should not be shown separately. You have to compulsorily net it off. There is no option. Pakka net jayal, sir. Remember, in DS1, what did it say? Offsetting is not permitted. First day we discussed. Unless it is permitted by any standard permits. PVDBO, closing balance, right? Minus plan assets net obligation. Are under what heading, sir? Non-current liability. Long-term employee benefit also long-term only. Retirement benefit is anyway very long-term. Pakka it will be classified as a non-current liability. There is something of that is payable immediately within the accounting presentation. This is a very popular. There is one more way of doing this. I will tell you that also. But in case you are able to learn that model, you can solve this sum in half time. Half time the answer you will get. Full marks you will get. Marks low discounting will not be there. But time half time you can reduce of this entire solving process. That is, you should try to learn net obligation account directly. Instead of drafting PBDBO and plan assets separately, you will combine them and directly prepare a net obligation. Do that, no sir. Entire numbers directly will be with you. Take that number and post. Now that you have the individual ledger accounts, you tell me opening balance of liability. 140. Plan assets opening balance. Net obligation. Current service cost is given as interest cost. Opening balance 60 into 4%. This 3.2 is gross interest cost minus expected return. Net interest cost is ultimately anyway P&L account it has to be netted off. No, you prepare two ledger accounts, time will be wasted. If single account la answer directly will get advantage. Contribution to plan assets is there. Bank. How much did you contribute? Perfect. To bank 30. What else? Withdrawals. By bank. How much did you withdraw? 25. Huh? But you again paid also. Here you can observe something. You should observe something. 20 paid, 20 withdrawn. Even if you don't write also, this account will have no impact. That is contra item, sir. So, sir, I will write, sir, right? Don't want to write, don't write. But if you write only one side, then that will be a problem. Full clarity you should have. Either write both sides or leave it. Sir. Now, finally, what is my closing liability? Closing plan assets. Net liability closing is balance this. You need to get 12.6. Somewhere we missed out something. Contribution. Contribution is Kerala. Now, the account if you prepare, what is the advantage is they ask you extract, no? Very easy for you to bring the number. This is a PRL item. This is PRL item. Actuarial loss depends. Sometimes PRL, sometimes so nothing is given. Follow it as 30, 2.4, 12.6. Your answer here. 1 for 32.4, 12.6. Direct extract one single account. Next, balance sheet extract. Directly closing balance. Instead of preparing two accounts, single account. The net obligation. Literally merge these two accounts. That's it. Nothing else. This one contra item. Is there a contra item? Whether you write or don't write, it doesn't. Now, I want you to observe something. PBDBO 3000 I am having. Liability. Plan assets I am having 2200, which means net obligation is the present state. I paid a liability of 200. Tell me the entries, individual entries. I paid 200 rupees liability. I have to pay, first I have to withdraw money. Entry will be what? Bank account debit to plan asset. An amount of 200. I withdraw money. Then I paid PBDBO account debit to. Because of this, liability will reduce or not? Net liability will not reduce. Liability will reduce, but net obligation will not reduce. A balance sheet 800 number is there, no? In that change will not come. Why will it not come? You can see now. PBDBO from 3000 it will become 2800. Plan assets 2200 become 2000. Net effectively it is appearing at. Can you observe that net obligation point of view, amount withdrawn and paid is not having any impact. That's exactly what you can. Question, sir? Right. Now, sir, why is it not happening? When I paid money, my obligation should reduce. No, why is it not reducing? When I pay, it should reduce. No, you may say, both sides it is reducing. No, sir, that's why. That is mathematical. Mathematically, you are right. It is reducing, but this is also reducing. Therefore, this amount will remain same. Mathematically, okay. But don't you think that when I pay my liability, a balance sheet obligation should conceptually? It's not reducing. No. No, what's the meaning of that? It is liability. This is not liability. Liability only, but that 800 is actually not representing your gross liability. That is representing a shortage. Representing a shortage of a deficit. I have a liability of 3000. For that liability, I already have assets worth 2200, but I am still falling short by 800. For net obligation basically represents deficit. How much further amount you have to arrange to meet the liability. Understand, sir? Net obligation liability, but it is not representing your overall liability, representing your shortage of funds. Clear here? Right. In this one, last point, that is easy, right? Sir, there is a plan which I announced for employees. I told that to wait in the entity for a period of 10 years, 10th year ending, some X amount of benefit I will give. Since everybody agreed and all, I nicely am doing my PUCM accounting happily. Today, I am third year. Year ending, I am starting. Already liability created to the extent of 3. Our company is very happy with the way in which our business is progressing, the way in which our employees are contributing to it. So we graciously told that employees, we told you that we will pay you this amount, but now standing at the end of third year, we are revising, we will not pay you this amount. You are increasing the benefit payable to the employees in. Again, sir, observe now. Your original accounting, what happened in the last 3 years, based on this original benefit, what you promised, but now are you revising the benefit? You are promising to pay higher benefit. When you are promising to pay higher benefit, your liability should be 300 or it should be higher? Be higher. The existing liability sheet what you prepared, are useful or useless? So what you should do? Again redo the whole thing from the very beginning. To do like that, your PBDBO by now be 400. But actually it is how much? 300. But you updated the plan, you modified the plan. Because of the modification, liability increase is there. Now tell me, sir, half entry at least you can easily guess. 2 PB. An amount of. What is this 180, you know? Had I announced this revised terms on first day itself, by now my balance sheet liability would have been 20. The form of CSC and IC for first 3 years would be 480. But I already recorded expenditure. So relating to concluded period, today I have to at once book a cost of 180. 180 plus past service cost means for the services already received because of modification, how much extra liability I have to create now. This past service cost will obviously go up to why our services are already received. No, cost also should be booked up to P&L account. Current service cost means what? For the service what you rendered in the current year, how much do I owe you at the current service cost? For the services what you rendered in the past, how much do I owe you at the past service cost? Both entries are same. The CSC to PVDBO, the PSC to PVDBO, both will go to PRL. Here, sir, this is something which will keep. Next thing. In my balance sheet, I have a PVDBO of 3000, last point, sir, and I have a plan assets of 1800, net obligation. Our company is in worst financial position. We are not in a position to pay monthly salaries also. I called all the employees, I told them that we are shutting down our division, your jobs are gone. I scared them to help for 1 week. Those people are trying for jobs outside session employment. Suddenly, I came and I told them a small good news. Jobs are safe, we are not removed. But you have to make a small sacrifice. What is that sacrifice? I promised you a bonus. Forget about that. Not get that. Willing to forego bonus will somehow manage to keep you in employment. 4 employees fall in your trap, accept. Balance sheet lo whatever PVDBO is there, 1000, that you need not pay it. Liability, financial liability need not be paid. You only know happily take off. This is called as curtailment. Modification la benefit is increasing, curtailment la benefits is decreasing. Cancel. Liability reduction of gain comes, it will go to. Sometimes in this, curtailment will happen with settlement. You call all the employees and tell them, we owe you how much? 3000 sir, but we will pay you only 1800. Remaining amount you have to forget. I says okay. In that case, what you will do? To bank 1800, whatever you are paying, you write that. The remaining what you need not pay, gain on curtailment will do. So, sir, if PVDBO history, if you see, what is the entry? CSCIC to PVDBO. A CSCIC are created via URL. When the liability is not payable, a reversal also should go into URL. That's the whole part. Sir, with this, we are done with our defined completely. This overall, if you observe, initial PUCM we learned, plan assets accounting we learned, and individual ledger accounts how to prepare, net obligation how to prepare, balance sheet and P&L account presentations how we have to do. Then we learned modification of defined benefit plan. We have seen curtailment of defined. That's all. Defined benefit plan is over. Now coming to contribution plan. Contribution plan, there is no accounting specifically, sir. It is like when you make any contribution, a contribution should be as expenditure in your P&L account. Tell me, sir, in a particular month, your total salary in your company is 15 lakh rupees. PF is 12%. What is the entry you write for PF contribution? All must have seen PF contribution. What entry will you? Or the entire salary paid entry you tell me, including PF. First of all, what is the cost to the company? Salary basic I have to pay anyway, how much? 15 lakhs. Plus, on behalf of employee, I have to contribute to some authority, how much? 12%. So overall, we have to pay to the employee how much? Lakh. Called as cost to the company, correct? For this entry, we have to write. Carefully watch. Salary account debit 15 lakhs. This is short-term employee benefit. PF contribution the amount of to bank. Tell me, sir. Employee ki how much will you pay? To the employee, how much will you pay? 15 lakhs minus his share of PF also you have to deduct, no? My share of 12%, that fellow share of 12% also will be there. What you will do? You will not pay him 15 lakhs. Lakhs minus employee's share. Here what I wrote is the employer's share. This anyway will not pay him, I will pay directly to the authority. So net I will pay him only 1,20,000. So 1,80,000 I withheld from him. 1,80,000 I also am adding. Overall, I will create a liability account as whenever I pay payable account. Or where is accounting of contribution plan? Go in this of 2. Is that simple? Plan is simple, no. Accounting is also simple. Benefit plan accounting is not simple, no. Plan itself is complicated. Somebody will pay money after 25 years. How much expenditure I have to book in the current term is, do you think that's easy? The liability sheet and all, whatever I showed you, that's for one employee. In real life, how many employees will be there? Thousands of employees will be there. They'll all have the same salary, same age, same escalation rate. Very complicated stuff. Next, some people will leave. When that fellow will leave, I don't know. Some fellow will die. Don't know when he will die. All these estimates they will take. Based on that calculation. Calculation you will not do. Actuary, another professional. Anyway. So guys, this is about defined contribution plan, defined benefit plan. Short-term employee benefit is over. Now final one, this is as termination. The termination benefit, one small advantage is there from an accounting perspective. What is the advantage is, out of all the 4 plans, this is the only plan which is unplanned. I know when I have to pay normal salary. I know when I have to pay long-term employee benefit. I know when I have to pay retirement benefit. This one, I cannot plan in advance, no. At the time of joining only will I tell him, sir, after 5th year ending I will remove you. Can this be planned and accounted? But rest all can be planned and accounted. This cannot be planned. So this accounting will start only when obligation. Event should happen. VRS should announce, that fellow should accept. He should resign, we promise to pay retrenchment compensation. Obligation should be there. Unless that event gets triggered, the accounting will not start. Okay, now, in this one example directly I have given. Follow this example, sir. Given in the book. Excel Limited announced a VR scheme for the year which was accepted by the employees. As per the agreement with the employee, a total compensation of 2,000 lakhs is payable, out of which 1,500 lakhs is payable immediately and 500 lakhs is payable on 31st March 2020. 31st March 2020 is after 2 years from the current year. Some amount you are paying now, some amount you are paying or likely to agreed to pay after 2 years. The discounting rate is 10% per annum. Show the accounting in the books of Excel Limited. Now, overall VRS compensation payable is 2,000 lakhs. Whatever standard says it, if VRS amount or retrenchment compensation is payable within 1 year from the end of the 31st March without doing any discounting, gross amount to book it as expense in your P&L account immediately. If something is payable beyond 1 year from the end of current year, then you have to recognize it as an expenditure on present value basis. Now in this I wanted it took both the cases. Total amount what I promised to pay is 2,000. In this 2,000 immediately I agreed to pay 500, 1,500. Another 500 I promised you to pay after 2 years. If it is after 1 year, no sir, I cannot discount it. I wanted it to take a case of payable after 2 years. So 1,500 lakhs whatever is payable now immediately at the full gross amount kept recognized expenditure, whereas 500 lakhs whatever I have to pay after 2 years I have to recognize that at present value, discounted by 2 years. That came to 413.3. Here it is coming as 15. Total it is 1913.2. Look at the entry. VRS compensation expense account debit amount to bank whatever you are paying, whatever you are not paying, that will be a liability, VRS pay. And as you can understand that since it is recognized at present value, every year you have to do unwinding of discount. Otherwise, a 413.2 will not become 500 after 2 years. By ACM accounting, you will do interest cost account debit to VRS payable, interest cost account debit to VRS payable, and one day it will become 500 so happily. Here, sir, this is about termination. The entire standard, sir, even though it has consumed some time for us, Standard is extremely important, especially the defined benefit plan wala story is highly. So guys, that's all with your benefit.